Good morning, everyone. Welcome to the Macro Snapshot, beginning of a new week. We are Monday, July the 21st, 2025, about 7:30 in the morning. Okay, so let's just have a quick review and see what's going on. Not a huge amount of news overnight, over the weekend. I guess the main thing is Trump was furious that the media thought that Treasury Secretary Bessent had been explaining how the Fed works to him. He issued a tweet, which I thought was quite amusing, saying that he explained things to people. Nobody explained anything to him. Anyway, so it looks as though at the moment Bessent has convinced Trump not to fire Powell. And of course, in terms of the FOMC, we do have a blackout period this week, so there shouldn't be any sort of Fed speakers until we go into next week's meeting. So hopefully not too much action on that point. At this point, we could look at the thing at the probabilities, but basically about two cuts are still priced for the end of the year. Just under that, I think it's at about 47, 48. Let's have a quick look just to refresh ourselves at the beginning of the week. So it is, where are we? Oh, yes, here. Okay. So as you can see here, for the upcoming meeting on the 30th, so 9 days away, only 1 basis point of cuts priced in. And if we go out to December, about 46 basis points of cuts priced in. So just under 2 cuts. So at this point, that's where we've been for the last couple of months. We don't really have much data this week. And so probably the front of the curve is going to be fairly stable, I would imagine, but we'll talk about that in a second. Now, in terms of other stuff over the weekend, we had some news that the Europeans are meeting and preparing sort of retaliatory tariffs in case Trump continues to play tough on tariffs, including potentially taxes on some of the huge American sort of tech companies. We shall see when and if that happens. But probably the most important thing, we spoke about it on Friday, was the election results in the upper house chamber in Japan. Now, that had expected to be sort of a potential loss of the majority for the ruling LDP Komeito coalition, and that's indeed what happened. So the Liberal Democrats, which of course is the sort of pro-stability, pro-American, everything conservative, has been in power for seven decades. They did actually lose their majority, but they didn't lose it by as much as the market had feared. And also, secondly, the Prime Minister Ishiba, he basically said, listen, I'm too busy trying to deal with tariffs and everything. I'm not going to resign. Yes, I understand that we need to do better, etc., etc. But basically told everyone that he would stay on as Prime Minister and would not resign. So therefore, a voice of stability. And the market quite liked that. The Japanese yen quite liked that. If we actually look here, you can see here that USD, Japanese yen, you can see that US dollar initially spiked up, but actually has been coming off. And if you look at the yen versus some of the cross pairs, you see against the euro here, the euro down against the yen. And let's just say something like the Aussie, also down a little bit against the yen. So the yen actually strengthening, not massively, but a little bit, just on the news that Prime Minister Ishiba would not resign. Also, there's an increasing realization that the opposition parties did make gains in the elections on Sunday, which in theory is not great for stability. But the point is they seem to be so scattered and they're not in some kind of formal or sort of close-knit coalition. And therefore, the chances of them actually shaking the LDP appear limited. And it looks as though the market has taken some comfort from that, and that the opposition is not particularly united. So all that to say, no huge dramas, no huge sell-offs in the Japanese bonds. And as we see, the yen here actually, rather than weakening, actually strengthened just a little bit. So that's relatively stable. So let's just take a look and look at a couple of other things going on. Let's just have a bit of review of the bond market, just see where we're at. So if we look at, as I was saying, 2-year yields here, you can see the 2-year yields here down to about 3.85. They've been coming down the last 4 or 5 days or so. Again, what I've been saying for a couple of weeks, the market, as we just saw, is still pricing in 2 cuts for the end of this year and more cuts in 2026. And it seems to me that the market at this point is essentially saying, depending on the economy, economic data, if Powell survives and whatnot, there will be cuts coming. The economy is probably going to slow down. We don't exactly know if it's going to be in the next quarter or 2 quarters or 3 quarters, but at some point, the front end of the curve, the yields will go lower and the Fed funds rate will go lower, potentially even by more than the market is currently pricing in. And so therefore, what I'm trying to say is that the chances, there's almost like a cap here on the top of the yields. And it looks as though, this level here at about about 4.05 is really going to be sort of the top. That's about about 20 basis points away. So I do expect just over the next few weeks, we'll probably just meander up and down, just trading in a range, more or less where we are at the middle at the moment. As you can see here, we're sort of more or less in the middle of this range. Which is about 4.05% on the top side, probably down to about 3.7 on the bottom. So just depending on a little bit of economic data here and there, that's going to be pretty stable. Talking about economic data, we don't really get any this week. We get some flash PMIs in the States. We get some housing data, I believe, on Thursday, and we do get the ECB meeting. But apart from that, there's not a huge amount going on. And as I say, we have a Fed blackout. There are some earnings. A couple of the major companies are starting to sort of report earnings a bit later in the week. So we'll get onto that then. So in terms of the bonds, as I say, the main sort of thing we need to be looking at is probably just the shape of the curve. So the front of the curve is relatively so sort of stable. But as soon as you go out to the back of the curve, you can start to see that in general, that's been going up a little higher. It has come down a little bit in the last couple of days. But overall, the tendency, if you look at something like the fives, whereas the fives 30s, you can see that it is sort of steepening. So the general sort of message, I guess, from the bond market seems to be one of steepening, which is essentially saying that the economy is doing okay. Issuance still remains an issue, no pun intended, it still remains a problem just because the deficit is not being reduced. Inflation is still a little bit sticky, but the front end of the curve should be relatively anchored. So all in all, that's giving us, let's say the 5s 30s here, quite a lot of sort of steepening. If we look at the 2s 30s, not quite as much because what's really starting to steepen is the duration here. But really what's quite important here is I mean, actually, I just want to get back to the 530s. Just looking at the levels here, what's a pretty important level here is something like where we're at. It looks as though this could sort of push a lot higher here. So let's just keep an eye on this. But really what so I just want to look at something in my notes here. No, I just missed out. That's fine. But really what I want to draw your attention to is something even like the 10s 30s. So if you look at the 10s 30s here, which normally is relatively tight, but this is really sort of starting to sort of push out here. And this is almost like a pure expression here of a term premium. You see here we're at 56 sort of basis points. And that just keeps on pushing out. And really what that's doing here, let's just have a look. It's really just a function here of, if you look at the real yields and the term premium. So if you look here, this is the real yields. This is a monthly chart on the US. So we have here the 5. And we have the 10, but look at the 30 here. This is the 30-year real yield, which is now to 2.6%. So 2.6%. So that's the nominal yield above inflation expectations. And as we can all see, that has basically been going up, quite sort of steadily, and that's continuing to push up. And so if we also then look at the term premium, there's different ways of measuring it, but the Adrian Crump index is the one which most people like to look at. You can see that the term premiums are also up to about 55 basis points. So again, if you look at the 10s to the 30s and the term premium, this is really saying that the market is nervous about the long end and does expect inflation not to be reined in. It expects the economy to remain relatively robust, and it expects fiscal ill discipline to continue. So basically more and more issuance. And that's why we're starting to see that 10 to 30 really push out, and even the 30s pushing up a lot more than the 10s. And of course, the issue here is what happens to the real economy, because historically, when you have real yields, we just get back to the real, when you start to have real yields at 2.6%, that does become, no pun intended, a real problem for the economy. And if we actually go back now, I'm just going to sort of scroll back, you can see that we really haven't had this sort of, height or sort of level of real yields. You have to go back, almost getting back, 15, 18 years or so. And it looks as though, if at least like the high down there was about 3.2%. I'm not saying we're going to get to 3.2% on the real yield on the 30, but just sort of technically looking at the chart, that would be sort of the resistance level. And so there's no reason why they can't just sort of keep on crawling up there. And if you start getting a real yield at 3%, that does become a problem for the real economy. Projects to finance become very, very expensive. If you want to put up some condos or a shopping center or any kind of project which requires longer term financing, that becomes prohibitively expensive. And of course, that starts to sort of cause the economic weakness, and then you start to have problems in the equity market. So let's keep an eye on those real yields. I'm not saying it's going to crack the equity markets and the real economy tomorrow, but but definitely the further up they go, that's gradually tightening the screws on the real economy. Now we're going to get some more information just about issuance and whatnot coming on July the 28th, which is basically a week from today, where they give the overall numbers, and then on the Wednesday, July the 30th, which of course also is Fed Day, where we get the composition. And what a lot of people are saying is that essentially they want to bring down the lower end, the yields on the longer end of the yield curve. And normally, one way of doing it, they might sort of be doing some buybacks. So buybacks, normally what that means is that the off-the-run bonds, so those bonds which were issued, let's say, for example, you have a 10-year or 30-year bond, but it was issued, 12 or 13 or 14 or 15 years ago. That bond is still in the marketplace, but it's what they call off the run, which basically means that there's very low liquidity because it's not traded much. So on the run are the most recently issued bonds, let's say in a 30-year, so they have quite a lot of liquidity. So the further out you go in sort of back in time, so bonds which were issued, 5, 10, 15 years ago, they are off the run, they're less traded, there's less liquidity, there's a liquidity premium, so the yields are up. So the idea here is that the Treasury, one of their schemes to maybe try and reduce our sort of yields on the long end of the term, is to do some buybacks. So the idea is that they will buy off the market or from the market the off-the-run bonds and reissue new bonds. Now, normally they would reissue coupons, so similar kind of duration. So if you remove from the market and do a buyback and take back off the run bonds, you would replace that or pay for it by issuing a similar duration. But the idea is that what maybe sort of Besant's Treasury wants to do is to issue a lot of bills. So the idea here is that rather than just cutting coupons, which politically is difficult, because you imagine if they could come out on the QRA on the 28th of July and say, oh, we're not going to issue as many long-term bonds, we're going to cut the coupons, we're going to issue a lot more bills. So the front end of the curve, that would be seen as naked, sort of an obvious manipulation, which the bond market might, the bond market would like it, but there would generally be a sense that was sort of political interference and manipulation of the auction process. So a sort of a more subtle and maybe a sneakier way of doing that would be to remove from the market, as I said, the off-the-run sort of bonds, and instead of sort of paying for those with a similar coupon, they could actually then pay for those by issuing bills. So the point there is that there'd be less of the longer-term bonds in the market. So all things considered, that should push down those longer-term yields and would actually flatten the curve. And so what I'm trying to say here is that could be a bit of a sort of a twist operation. And if we actually look back and look at some of the curves, and as I said, the overwhelming sort of tendency is to sort of have some curve steepening. You see here 10s, 30s, as we just talked about, the 5s, 30s steepening. Let's have a look at the 2s, 10s, maybe not as much, yeah, a bit flatter, but really out the curve, you see that steepening. And so what I'm trying to say is before we get into any steepener trades, we may want to get through the QRA, because there actually could be some flattening if the US Treasury and Besant and Trump, they do it in such a way that there's more front-term issuance and they remove those sort of longer dated bonds, the off-the-run bonds from the marketplace. So that could cause the long-term yields to come down. Actually, we could get a little bit of flattening in something like the 5s, 30s. It could sort of flatten back here, and even the 10s, 30s could flatten down a little bit. As I say, I think the medium-term sort of trend is a steepener, but we have to get through the QRA to get through that. Sorry, just grabbing a little bit of tea. Okay, so let's keep an eye, all that to say, let's keep an eye on the 10-year, but especially the 30-year nominal yields, which are now up to, what are they up to now? Well, now they got through the 5%, but they've just come back just a little bit here. So just hovering around the 5%. And as we saw, the real yields up at about 2.6%. Okay, just going over to Germany, just in the German space. Now we do have the ECB, and as we can see here, we'll just bring up what's sort of priced into the market at this point. If we look over and look here, you can see that the meeting coming up, which is on Thursday, you can see that absolutely zero is expected. So basically, at the moment, the effective rate is around about sort of 2%. So keep in mind the 4.33% in the US, so about almost 2.5% less than the US. The ECB, as we know, have had a relatively aggressive cutting cycle. So absolutely no cuts priced in until we get until Christmas, the end of the year. So we get one further cut for 2025 priced in. So less cuts priced in at this point than for the ECB than the Fed. And that makes sense because the ECB, as we know, have cut down, as we can see here, to basically about 2%. And also inflation in the ECB seems to be, if anything, deflationary sort of trend rather than inflationary. Because remember, if we have higher tariffs, that's actually going to be maybe potentially higher inflation in the US, but for the rest of the world, maybe deflationary as the cost of goods sort of rises. Okay, so not a lot going on in the German 2-year. As I said, they're not expected to cut. If we just actually look at the 2-year yield here, I'll just see if I can find it. Yeah, so here's the German 2-year. And as you can see, this is almost like a dead contract here, just sort of trading in a very, very tight range here between about, let's call it about 1.8, 1.9% or so. Again, we know that the ECB cut rates, we see that sort of coming down and not a huge amount coming up this week. So, but there is still then a little bit of a curve steepening there as well. If we look at Germany, so if we look at let's just bring up some of the curves. So if we look at the 2s, 10s, you can see that definitely steepened. If you look at the 2s, 30s, you can see that steepened. And if you look at the 5s, 30s, you can also see that steepening. So my point is that all over the world, the curves are steepening. The idea is that the front end of the curves are relatively sort of stable and in some situations potentially going down a little bit more. Whilst the long end of the curves, they are staying relatively elevated. And just because markets are worried about sort of deficit spending, infrastructure spending, defense spending, all of this stuff costs money, and it all needs to be funded by extra long end bond issuance. So the trend will be to buy dips, or could be, or should be, to buy dips on the curve. When the curve flattens significantly, and to go into steepness both in the US but also over in Germany. Just having a quick look over at the dollar. Now it's interesting here because there's been a lot of dollar bears, but just the positioning was so short that the dollar has had a little bit of a bounce. Now structurally, one could argue that there's still more sort of downside. I think at the moment it's just trading. We will probably want to see what happens around the QRA, because remember, if the QRA, if they do cut coupons and they do somehow get the long-term yields down, that would be very positive for equities, and that will be a negative for the US dollar and a positive for the euro. So there could be like a binary event happening around the QRA, which, as I say, is next Monday and then Wednesday for more detail. And so at this point, the dollar has bounced and it's come off a little bit in the last 48 hours or two trading sessions. But I don't know that that's such a huge thing. It looks to me like this level up here, about 98.9, about 90, late 98s, something like that. That's a bit of a key level. And as I say, if we do get a significant cut in coupons next week at the QRA, it wouldn't surprise me to see the dollar come down significantly. On the other hand, if they don't do that, it could be that the dollar kind of grinds a little bit higher. So who knows? I mean, probably a reasonable kind of strategy. If we also look at something like the euro, which is going to be a binary event with the QRA, similar kind of situation here. You have what looks to be like sort of some kind of Fibonacci retracement. Is this a bull flag? Is it sort of pushing higher? It's possible, but again, I don't think there's going to be too many catalysts this week unless we get something unusual coming out of the ECB. But I expect Lagarde to be fairly neutral. And again, it could be that when we get to the QRA, that either that's going to show dollar weakness or dollar strength, and of course that's going to be reflected in the euro. So some kind of volatility play might be more interesting here, like a sort of a long straddle or something like that. Although I'm not sure how expensive that's going to be, but something like a sort of a long straddle on either the euro or the US dollar could be an interesting one. All right, so. Just finally, just want to have a quick look over at one of the metals, because there's some talk over the weekend that the Chinese have given the green light to a huge dam in Tibet, which would be a very big infrastructure project, which would use a lot of copper. So some commentators over the weekend saying that this is an excuse for copper to take off again, and we see that copper here is pushing higher, has been pushing higher since Friday, and then since the futures market opened last night, it's pushing a little bit higher. So you've got to say that if this just represents a fib retracement pullback, potentially it wants to retest these highs up towards $5.80 in the US, and of course there is that lingering threat of the tariffs on copper coming into the US. So keep in mind that HG is the copper traded, the high grade traded in the US. It's not Shanghai or London, and it's trading at a bit of a premium. But still, copper lacking the news of major sort of Chinese infrastructure projects. And just finally, guys, I just want to have a quick look here. You see the VIX. The VIX is fairly placid, as you can see. It's not at its lowest levels, but this is very much sort of getting to a sort of a summer doldrums kind of situation here, about 16.5. So that's about implied of about 1% per day moves. And if you look at something like ES here, again, this is a strong chart, above all its moving averages, as we know. One thing I'd like to point out, though, is that if you look at a couple of the charts, let's look on the cash, and we look at some of the Bollingers. I want to put on the longer term chart because you can see here. I just want to put it on the Bollinger Bands here. And you can see here that, for example, is it overextended? So you can see the SPX, to be overextended, it has a little bit more space to go to get to the top of the Bollingers. But you can see that on the monthly Bollingers, they generally pull back. You can see back here, well, obviously that was COVID, but you can see in general, anytime we get to the Bollinger Bands, it generally sort of pulls back a little bit. So we have a little bit more to go, but it could pull back. And more to the point, I wanted to show you on the NASDAQ cash index. You can see here, we're actually getting to a level where we're getting quite close to being overextended here. So again, this is the monthly chart on the Bollingers. Obviously, it's a very bullish chart, but all I'm suggesting here is that we could be in time just for a little bit of a pullback and potentially maybe even that outperformance of tech over the rest of the S&P 500. And of course, we're starting to get some of the earnings this week and next week, especially next week for the tech companies. So that's something to keep an eye on. It's just that overextension there on those monthly Bollinger Bands. Okay, guys, I might just leave it there. As I say, not a huge amount going on today. Probably Trump will be tweeting, although I think I heard somewhere he's going to Scotland to play golf at one of his courses. So maybe on the golf course he won't tweet as much, but somehow I doubt it. Okay, have a great week, have a great day, and we'll keep this going every morning. Thank you.